So tonight we're doing the midterm review. I'll do pretty much just past midterm questions all night, and I'll skip the theory part because you can go and rewatch the other tutorials. I'll just drop some theory when needed, especially with some chapter 13 questions. So let's jump right in. Anyone has any questions before I start? Okay, so for question 1 is about accrued vacations. SY Systems Inc. has 10,000 employees. Each employee earns 20 days of paid vacation per calendar year. Up to 5 days of this entitlement may be carried forward and taken in the following year, but cannot be carried forward any further. Employees are not paid for any vacations they failed to take. As of December 31st, 2012, 9,130 employees had used their full vacation entitlement for 2012. The remaining employees are carrying forward an average of 3 days per employee, and they're all expected to use these vacations. All of the employee group earns $300 per day, and the other half work 8-hour days and earns $15 per hour. And this is representative of those who still have leftover vacation earned. What amount of liability should appear in the company's balance sheet at December 31st, 2012 with regards to accrued vacation pay? And then they give us 5 different types of answers. So what they're asking us is, what is going to be our salaries or wage payable at December 31st, 2012? They're telling us that of the 10,000 employees, there's only a small numbers of employees that didn't take their full 20 days for the year. So the numbers of employees that didn't take their full 20 days is 10,000 employees, which is their total amount, minus those that have taken their full vacation entitlement, so minus 9,130. So it's 870 employees. They're also telling us that they're carrying forward an average of 3 days per employees. So that's going to be in total, I'm going to put average number of days per employee. It's 2 days. Further rate, so how much money-wise that they're earning, half of the 870 employees are earning $300 per day, and half are earning $15 per hour and working 8-hour days. So for the half of 870, so the amount of dollars for those who earn $300 per day, it's 435 employees are earning $300 per day. They're accruing 3 days for the next year, and they are earning $300 per day. That's not the full amount that we're accruing, though. We also have to take into account the other half of employees that earn $15 per hour and work 8-hour per days. So those ones are accruing for 35 employees times 3 days times $15 per hour times 8 hours. I'll put the detail right here. So here I did 435 employees times 3 days times $300 per day. And here I did 435 employees times 3 days times $15 per hour times 8 hours per day. So the total that you're going to be putting down in your accrued vacations is 588,100. So it is answer 8. Any questions? That's honestly from all the midterms I've looked through to do the review, is the only question I found on salaries and vacation and stuff like that. Not saying that you're not going to get any questions, but you probably had a question on your assignment, so less likely to come back on the midterm. So hopefully that was an easier question to do. Any questions before I move on to question 2? Yeah, Samia.
Do we also have multiple choice in our exam?
Oh, sorry, can you repeat?
Do we also have multiple choice on our exam?
I think your exam is only multiple choice.
Oh, okay, thank you.
Unless I'm mistaken, but you should check on your course outline.
Thank you.
No problem. All right, so for question 2, it's on asset retirement obligation. You're for sure getting a question on this, for sure. So be ready. Yeah, thank you. So for the long questions like this, what they're going to do is that they're going to break all the questions into multiple choice. So here, you're going to, for the journal entry, they're going to put different types of journal entries, and you're going to have to select the right one. So Arrow, ACCO International, IC Inc. constructed a new production plant in northern Quebec at a total cost of $5 million, paid for with long-term bank loans for the production of its newly designed electronic bicycle, and commenced operation on January 1st, 2011. Its management expects the plant to remain in production for a period of 15 years. After that, the prevent stipulates that the company dismantles the plant and returns the site to its natural state. IC is required to bear all such costs, which it estimates will cost $750,000 for a complete restoration. IC uses IFRS, a 9% discount rate, straight line amortization, and has a fiscal year ending December 31st. First thing they're asking you is to record construction costs plus any obligation for land restoration costs related to the acquisition of the plant as at January 1st, 2011. So basically do the journal entry for January 1st, 2011. So the first thing that you want to account for is the fact that now you have a new production plant. So you want to record your asset. Your asset has a cost of $5 million. So you're going to put it in the books for that amount. And they're also telling you that was paid with long-term bank loans. So you want to recognize that also for the same amount. So you're going to have the plant and equipment for $5 million. And long-term notes payable for the same amount. After that, what's a little bit more tricky in this question, you want to record your estimation of your future restoration costs. So for that, normally they give you the amount you're going to have to pay in the future. In this case, they're telling you that they estimate the cost to be $750,000. And to record it in your book, you want to find the present value of that amount. So this, we're using IFRS, and it increases your plant and equipment account. And it comes to credit your asset retirement obligation account. The amount is the present value of $750,000. So we're using a rate of 9%. The number of period is the time of the project. So they expect it to be for a period of 15 years. So I'm going to put 15. There's no payment, and the future value is 750. So it's 205,904, and same amount in your asset arrow account. That's it for requirement 1. Then for requirement 2, they're asking you to record any entry required related to this asset and obligation at December 31st, 2011. So the first thing that you want to recognize is your depreciation expense for your asset, because now you have a new asset, right? So you want to put it in your books. So it's depreciation expense and accumulated depreciation. Okay. The amount, the book value now of your PP&E is the 5 million plus what we recognize with the arrow, so plus the 205,000. There's no residual value, and they're using straight line amortization, so we're just going to divide it by 15 years. Your second transaction on December 31st is going to be the recognition of your interest expense for your arrow. So we're going to come recognize an interest expense and also increase our asset or arrow account. The interest expense we're using interest expense because it's IFRS. If we were using ASPE, it would be accretion expense. But the amounts would be the same. The amount that we're going to do is 9% of what we recognize at the beginning of the year. So times 205,000. I'm so sorry if you hear my cat. Hopefully she'll calm down. Okay, and that's it. If they told you that they had production expense for the year incurred for the year that weren't production costs, that weren't recognized in January 1st and that they incurred during the year, you would also come and do a transaction for that amount. I think we're gonna see it for requirement 4 and 5 of this question. For required 3, now assume that at the end of 15 years, the company calls for competitive bids from independent contractors to undertake the dismantling of the plant and restoring the site. A local contractor, Quick Cleanup, puts in a bid which IC considers to be representing a fair estimate of the costs involved with the dismantling of the plant. Further, Quick Cleanup agrees to accept 34,250 common shares as fair compensation for the work undertaken. The shares were being traded at $24 each. Record this cost of dismantling the plant. So now we're at the end of the 15 years. Our project is done, and we're paying someone to come and clean up our plant. So what we're going to want to do on January 1st, 2026, I think. Yeah. What we're going to come and do, we're going to credit our full amount that we recorded in our arrow account. And this amount will be our estimation of 750, because every year what you're going to do, you're going to increase your arrow. So eventually your book balance should be 750,000. You're going to have a gain or loss. So I'm going to leave that blank for now. And the credit is whatever you're giving the cleanup company. Most of the time it's cash. And this problem is common shares. So we're going to calculate the fair value of the common shares that were exchanged. So common shares, and they issued 34,250 at $24. So here we can see that the cost ended up being more than what they estimated. So they're going to have a loss on settlement of arrow of 72,000 of 72,000. Here I did 3,450 times 24. Yeah, so if it was cash, if they said that they paid cash an amount, you would have just put cash and done your gain or loss. Here, same thing. Now assume for parts 4 and 5 that arising from the ongoing operations, scrap and waste materials were dumped at a nearby open site, which was used for disposing such production waste. The company was also required to undertake the cleanup at the garbage and site after the plant has ceased operations. As a result, it estimates additional annual recurring future cleanup cost of $48,000 occurring at the end of each operating year for such cleanup to be paid in 15 years. What are you doing? Get up. So requirement 4, record only the future cleanup costs from ongoing operations for the year ended December 31st, 2011. The company is using IFRS, so we're going to do the first transaction using IFRS, and the second transaction, same thing, but using ASCII. So for requirement 4, under IFRS, you put your production costs into your manufacturing overhead, so in your inventory. Under ASCII, you put them in your asset account that you recognize at the beginning. So in our case, it's going to be the plant and equipment account. And the following years under ASCII, you're going to have to depreciate that amount also with the balance of whatever you have in your PP&E account. So under IFRS, we have our manufacturing overhead, and it comes and includes an arrow. And again, we're going to have to find our present value of the $48,000 of future costs. The rate is again 9%. The number of years, since a year has now passed, we're at December 31st, we're going to put 14 years instead of 15. Original payment and future value is 48,000. And same thing here. And for requirement 5 under ASCII, same transaction, same amount, except for the debit account that is now plant and equipment. And that's it for question 2. Yeah, I'll leave it on for if you want to take a picture. Okay. For question 3, well, I thought it would be a little bit longer going through those, but I guess I'm flying through. So if I'm going too fast, just let me know. It's about sales promotion. Sales promotion, accounting for it is the same as the warranty expense method. So where you put down your expense for your estimation of the cost of the sale promotion, and then you come and reduce your liability once you have the actual costs of the promotion for the year. So for question 3, at the beginning of 2011, Cool Drinks Inc. started a sales program for one of its products. It requires its customers to collect the caps from the bottles of its drinks. In return for 10 such caps, customers will receive a keychain with the company's logo, which it purchases for 65 cents each. TDX experience indicates that 70% of the caps circulated will be redeemed. During 2011, 8.1 million bottles were sold, 520,000 keychains were purchased, and 3.5 million caps were redeemed. During 2012, 9.3 million bottles were sold, 262,000 keychains were purchased, and 5,520,000 caps were redeemed. On December 31st, 2010, TDX held 218,000 keychains in inventory carried over from an earlier adopted program at the same cost. We're going to first record all the appropriate journal entries for all the transactions for the years 2011 and 2012. For the sales promotion questions, I like to do a little table to just help visualize, like, because there's so many information that you're kind of like, where do I go from there? But you don't, if you're able to do it without the table, go for it. So first, I'm going to put a column down for my premium inventory. So here I'm going to put the number of units that were bought and sold during each year. I'm going to put my expected redemption of keychains. And I'm going to put it in units and also in dollar. Where is it? Here. All right, we're gonna dot. Here I'm gonna put the actual redemption of keychains. again in unit and in dollar. And here I'm going to put my liability balance, but I don't think it's required for this question, but just good practice to have it. So first, I'm going to try and find my beginning balance amount for the keychain inventory. They mentioned somewhere that in 2010, they had 218,000 keychains in inventory. So that's my beginning inventory. Then in 2011, during 2011, 520,000 keychains were purchased. So that increased my premium inventory. And what reduces it is the ones that were redeemed. So to find out how many units were redeemed, we drew the amounts of caps that were redeemed divided by 10. Divided by 10 because, because in return for 10 such caps, customer will receive a keychain. So we do 3.5 million divided by 10, find the number of keychains that were redeemed. So it's going to be 350,000 that were redeemed for the year, and we can put it down in our actual redemption column here for 2011. The expected redemption of keychains, so the amount of units that they were expecting, they mentioned that normally they think that 70% of the caps circulating would be redeemed. So we need to find the amounts of caps that were circulating for the years. And since common logic tells us that balls only have one cap, right? We can do 70% of the 8.1 million here and divide it by 10 to find the number of keychains.
Where did this 350,000 come from?
Yeah. So the 350,000 comes from the 3.5 million caps here that were redeemed. And we know that if 3.5 million caps were redeemed, that means that for each 10 caps, one keychain was given out. So you have to do the 3.5 divided by 10 to find the number.
Oh, okay.
And we're going to use the same logic here to find the, to find the number of expected redemption, because we're going to start from the number of caps that were circulated. So the 8.1 million. So that was the number of caps circulating. Divided by 10 is the number of keychains that amount of caps could be redeemed for. And they think that 70% of that amount would be redeemed, so times 70%. No. So it's 567 units that they think that they're gonna get redeemed. So this number of units needs to be represented in our premium expense account, and this needs to be represented as a decrease in our liability account. So to do our journal entries, we need to find the dollar values of those two numbers of keychains. So we need to find the cost of each keychains, and the cost is 65 cents. So I'm going to do the amount that we found in the unit column times 65 cents. And same thing here. So I can, with these amounts here, I can do my journal entries for 2011. So the first entry that I want to do, because they asked us to do all the journal entries, I'm going to record the purchase of the keychains. So the increase here in premium inventory. And let's say that they pay for them cash. So the amount here is going to be the 520,000 units times their cost of 65 cents. So this is to record the purchase of the keychains. Then I want to record my premium expense for the estimation of how many keys are going to be redeemed. So premium expense, and the amount is the amount that we found here, the 368,550. And my credit is going to be the estimated liability for premium. The same amount. And this is the estimation of how many keychains. And then at the end of the year, you're going to record the actual redemption of keychains. And this is a reduction of your estimated liability account that you put here. So I'm going to debit this account. And I'm going to come and reduce my premium inventory because it's the keychains, right, that they're giving out. So it comes and reduce your inventory when people come and say, hey, I want to redeem my premium. And the amount is going to be what we found here, the 227,500. And that's all the transaction for 2011. We're gonna now do for 2012. My beginning inventory for 2012 is gonna be, well, basically my beginning inventory from 2011 plus my purchases minus my redemptions. So my beginning inventory is 388,000. They bought in 2012, 262 keychains were purchased. So I'm going to add 262. And there was 5,520,000 caps to redeem. So we're going to do the same calculation as we did here for the 350,000. We're going to do the 5,520,000 divided by 10. And that's going to be the same amount that I'm going to put here for my actual redemptions of keychains. For the expected redemption, I'm going to do the 9.3 million bottles or caps divided by 10 to find the number of keychains and times the 70% for their estimation. And now you're just left to find your dollar amounts. So it's going to be my unit times the same cost of 65 cents because the cost hasn't changed. And same here. I'm going to put some spacers. All right. So now I can do my journal entries and it's going to be the exact same as what we did for 2011. So I'm just going to copy this here, and paste, and the amount for the premium inventory is going to be our purchases for the year, so the 262,000 times the cost of 65 cents. Then my premium expense is going to be my estimation of redemption of keychains, so the 423,000 that we found here. And the actual redemption is the 358,000. And that's it for the.
You are going to post this after this tutorial, right?
For the recording.
Hmm?
I'm not going to post the solutions.
Sorry?
I'm going to post the recording. I'm recording the story right now, but I'm not going to post the solution. So you're going to have to go back in the recording to find the solution.
Yeah, that's fine. That's fine because I can't exactly keep up with all the typings.
It's a lot at once. All right. Then they're asking us to tell them which items are going to be included in the financial statements for 2012 and show how these will be classified. So here they're not asking for the amounts, but if they did, with your table, you're going to be able to find them. So let me just put down. So I'll put them down just for the sake of it, because I think it's helpful for you guys to visualize it. So I'm going to put also the amounts. So first, on your income statement for 2012, you're going to have your premium expense. And that amount for 2012 is the 423,000 that we found here. And that's all you're finding on the income statement. On the balance sheet, in your current assets, you have your premium inventory. The amount in dollars that you're going to have is the balance here from 2012. So it's at the end of 2012, you have 98,000 units in inventory. So to find what they're going to have on their balance sheet, you do the balance at the end of the year times their cost of 65 cents. And in their current liabilities, they're going to have a balance for their estimated liability for premiums of, here you have this minus this. So that's the balance for 2011. So I did the expected minus the actual like we did here. We increase our expected and reduce it by our actual redemption. And for 2012, we start with the beginning balance of 2011 plus our expected redemption minus the actual redemption. So at 2012, they have a balance on their balance sheet for their liability account of 205,000. All right, so I'll try and fit all of this in one page. If you want to screenshot it. Yeah, so this one is really time consuming, and I hope that on your exam, if you have a question like this, it's easy and there's nothing like too complicated about it. All right, so if there's no question, I'll go for question 4, which is about warranty. So you'll see the accounting, especially for the expense method, is very, very similar to what we just did. Buildtech Inc. produces custom design machinery and equipment for individual customers. It manufactured and delivered sometime in early 2011 heavy equipment for lunar spacecrafts corporation at a selling price of $20 million with a 2-year guarantee for correcting any defects or operational problems arising during that period without cost to the buyer. The company uses a December 31st year end. At the time of sale, Buildtech estimated the eventual warranty cost to be no more than $1 million. Subsequent event unfolded as follows. Repair costs during the remainder of 2011 year amounted to $250. Further, in early 2012 and before the financial statements for 2011 were published, the company estimated that the total warranty cost for the 2-year could amount to as much as $1.3 million. During 2012, the company incurred actual repair costs relating to the warranty amounting to $703,000. From this amount, $27,000 being cost on credit was paid in 2013. Required, so under the expense method using IFRS, Prepare in good format journal entries to record both the cost and liability, if any, associated with the warranty for 2011-2012. So we're going to do that first. So under the expense method, and we're going to start with 2011. So when we're using the expense method, the warranty is sold as part of whatever it is, the cost of what they're selling. So they're not separating the amount estimated for warranty as like a warranty revenue. It's all together. Because of that, what they're going to do is that they're going to set up a warranty expense for their estimation of warranty costs associated with the sale, like we did with the premium expense. And when they incur the actual cost of warranty, they come and reduce the liability account that they created when they set up their warranty expense. Let me show you in journal entries. For 2011, they're going to first record their estimation of the eventual warranty costs. That amount is $1 million. It's $1 million because they estimate that the eventually warranty costs to be no more than $1 million. Normally it's given, or you have to do some calculation, but it's always the estimation of what they think the warranty costs are going to be. So here is the estimation of the actual warranty. Then later in the year, they actually incurred the warranty cost. They incurred $250,000 in costs. So here, what we're going to do, we're going to come and reduce our liability account by $250,000. And let's say that they pay cash for it. It could also be your accounts payable. They're not mentioning it for 2011, so it doesn't really matter what you put down. So normally it stops here, but they said that they already have their estimation for 2012 before the financial statement for 2011. So because of that, in 2011, we're going to record our estimation for 2012 also, instead of estimating it in 2012. So let me repeat, because we know the estimation of the total warranty cost for 2012 prior to the release of the financial statements for 2011, we're going to record our estimation, so our warranty expense and our estimated liability for warranty with the number of 2012 and 2011. So I'm going to reuse that same transaction here. And instead of putting 1 million, the expected warranty costs for 2012 were 1.3 million. So that's what I'm going to put down. And here it's because we knew the estimation for the release of the 2011 financial statements. For 2012, they're not going to have to record their warranty expense because they already know it. So they only have to record their actual warranty costs. And their actual warranty costs were $703,000 for the year. So this comes and reduces our estimated liability for $703,000. Here they tell us that actually from that amount, there was $27,000 that were on credit, so that were in our accounts payable account. So we're going to put accounts payable, 27,000, and the balance is going to be cash. For requirement 2, what should be done to resolve any balances related to the warranty remaining on December 31st, 2012, and prepare any journal entry required. So what they want to know is at the end of the 2 years, technically, if you estimated your expenses correctly, your estimated liability for warranty account should be 0, but that's rarely the case. So what happens if at the end of the 2 year, you still have a balance in your warranty account? To do that, we have to find our balance at December 31st, 2012 of our warranty liability, estimated liability for warranty accounts. Liability. So here, what I'm going to do is I'm going to record. I'm going to find it by basically doing an increase of 1 million, reduction of 250, an increase of 1.3 million, and a reduction of 703. Yeah. Yeah. So there's a balance at December 31st of $1.347 million on their balance sheet. This amount, their warranty is done. So this amount is never going to be reversed, right? Because there shouldn't have any other actual warranty cost associated with that sale. So, and also what happened is that they recorded way too much warranty expense in 2011. They recorded 2.3 million when it should have been 953,000. So you want to come and reduce your liability account to get rid of that amount. And you also want to come and reduce your warranty expense account that you overstated in previous years. And that's it for requirement 1 under, for the expense method.
Could you just,
what?
sorry, could you just repeat that last part that you just did? Yeah.
So first, what I did is I found the balance of the estimated liability account at December 31st, 2012. So I did that by basically adding my credits in my transaction and subtracting my debits. What happened is if they have a balance here at the end of their warranty program, that amount is never going to be used as warranty costs because there's no more warranty on those sales. So they estimated more warranty expense than what actually happened and cost them. Because of that, you want to come and, well, reduce your liability because they're never going to be used, but you also want to come and reduce your warranty expense that you estimated as too much instead of what actually happened. So here you estimated your warranty expense to be 2.3 million, when actually it was only, I think, 953,000. So you want to come and reduce it by the difference between the two.
Okay, perfect.
In an ideal world, you wouldn't have any balance here. It would be 0, but it's not the case.
Okay, I get it. So you're just reducing the, well, taking off the excess, basically.
Exactly.
Awesome. Thank you.
No problem. Now, under the revenue method, we're going to do all the journal entries, but they're giving us a little bit more information here. So assume for this question only that the company bills into the sales price a margin of 10% of final selling price as revenues related to warranties. It was considered reasonable to allocate 30% of their revenue to 2011 and the balance to 2012. So here, under the revenue method, instead of recognizing an expense and an estimated liability, and then you reverse your liability, you instead record a warranty revenue or an unearned warranty revenue. Your warranty revenue is recorded when you incur your actual cost of warranties. So we'll see that for this problem. So for example, in 2011, they had the sale, right? They sold heavy equipment for lunar spacecrafts at a selling price of $20 million. So here they have their accounts receivable for $20 million. Of that amount, you're going to record your revenue for the sales. And also a warranty revenue, and also maybe an unearned warranty revenue. Depends on what the problem says. For the sales revenue, they say that a margin of 10% of final selling price are related to warranty. So that means that 90% of the selling price is for the sales revenue. So I'm going to do 90% of the 20 million. And that leaves us with $2 million that's going to be attributed to warranty revenue or unearned warranty revenue. For 2011, they allocate 30% of the revenue to 2011. So I'm going to record right ahead the 30% of 2 million. And I'm going to put the balance in the unearned revenue because technically it's going to be only earned in 2012. You could also put the full amount. You could also do it like this and put 2 million here. And at the end of the year, you do, okay, I reduced my unearned warranty revenue by 30% of the 2 million to recognize my revenue for 2011. And I recognize it in my warranty revenue account. So it works. And you also have to record an expense for the actual costs of warranty. And for 2012, those actual costs, for 2011, the actual costs are still $250,000. So my warranty expense is the $250,000. And here it could be cash or accounts payable or inventory, depends what they provide. So here I record my actual warranty costs. And here it's 3%. That's it for 2011. For 2012, you're going to want income and recognize some of the warranty revenue. So I'm going to do the same transaction as I did in 2011 to recognize it. But the amount now is going to be the balance here. So it's going to be the 2 million that we recognize in the unearned warranty revenue minus what we recognize in 2011. So it's going to be 1.4 million. And then you want to recognize your actual cost of warranty. So it's going to be warranty expense of $703,000. And they still have an accounts payable of $27,000. And the balance is paid cash, I'm assuming. But could be something else. Oh no. What's paid in? Yeah, it could be something. It could be inventory too. And am I missing anything? No, that's it for this question. So here I did the 2 million minus the 600,000. So the difference between the two, just to remind you, under the expense method, you expense your estimation, and on that transaction, you do a credit to your liability account. And when you incur your actual costs of warranty, you debit that liability account. If at the end of the warranty program, you have a balance in your liability account, to reduce it, you credit the balance, and you come and you debit the balance, and you come and credit your warranty expense account for the same amount because you expense too much in previous years. Under the revenue method, your warranty is sold apart from the good. You can buy it separately. So you want to record a revenue for that warranty. You're gonna normally put it down as unearned warranty revenue because the actual cost of warranty hasn't happened yet. When you incur warranty costs, you're gonna come and recognize some of your warranty revenue. And you're also gonna come in and recognize a warranty expense for the actual warranty costs for the year. There shouldn't be any balances because at the end of the program, because you're not using the estimated liability. There could be balance, I guess, in the unearned warranty revenue because but technically it's not linked. The amounts that you recognize each time are not linked to the amounts of warranty expense, so you should be okay. And that's it for question 4. For question 5, contingencies. It's a long problem. DCI acquired a controlling interest in New Tech Engineering Inc. (NEY) in June 2017. It was a relatively new company and had been in operation for just over 6 years before it was bought over. Initially, NEY had been set up by 2 leading scientists, Mr. Cam Physics and Electric. The 2 funders were seeking additional capital for expansion, which DCI offered. The terms were for the founders to remain and work as consulting directors for a period of at least 5 years following the acquisition. In return, DCI would purchase a 60% stake in NEY and would compensate the 2 directors at an annual fee of $250,000 each. The consultants, in turn, would engage themselves in the development of new technologies for space exploration and defense. Unfortunately, the plans did not work as desired. On July 4, 2017, the 2 scientists died in a tragic air accident, and now the future plans came to a near-dead stop. The shares of DCI plunged and lost market value estimated at between 25 and 30 million. Sometimes in 2018, a splinter group of shareholders sued DCI for their investment losses amounting to nearly $600,000. The company's legal counsel feels that there exists very low possibilities that this case will succeed. Further, DCI terminated the consulting contracts with 2 deceased directors, but offered each of the 2 widows $150,000 as sympathy compensation. The widows refused the offer and sued DCI for the full 5-year compensation as originally contracted. The company legal counsel feel that in this case, there's a 10% probability of the widows being awarded the full amount claimed, 20% probability of the claimants receiving a 2-year compensation, and a 70% probability that the company's offers will be accepted by the courts. You are required to provide accounting and disclosure advice on the correct course of action to be taken for each of the 2 pending lawsuits. Specifically for 2018, with some briefly stated reasons, determine the liability in each of the 2 cases, how these should be reported, and provide appropriate journal entries if such liabilities need to be recorded in the books of accounts of DCI. Okay, first of all, what's the 2 possible, what's the 2 pending lawsuits? Anyone wanna try and guess? No? Okay. So you have 1 lawsuit from the shareholders with their investment losses, right? Because the share value of the share tanked after the Very dramatic problem, by the way. That's very dramatic. But yeah, the value of their shares plunked after the debt, so they're not suing the company. Second lawsuit is with the two widows, which they're refusing their offers and they're suing DCI for the full 5-year compensation of the two husbands that are dead. Also, DCI is following IFRS. It's not mentioned here, but it's because this midterm, like all the questions are linked together, but DCI follows IFRS. Right? Not that it really matters, I guess. Yeah, so DCI follows IFRS. So for the first lawsuit for the loss of the market value of the shares of DCI, what's going to happen here? First of all, what you have to look at is what does their legal counsel think about this lawsuit? Do they think that they have a 50% chance of paying the amount to the shareholders? And in this case, they said that the company's legal counsel feels that there exists very low possibilities that this case will succeed. So that says, okay, very low possibilities is very less than 50%. So no transaction is going to be reported. You could, I'm going to put it down. So since the legal counsel feels that there's a possibility of no reporting liability. Under IFRS, it's okay, so I just put down the theory. What you could do though is the event could be reported as a footnote on the financial statement to comment also the future performance of the company, because I don't think shareholders are going to stay in this company if the market value decreased by 25 to 30 million. So I'm just going to copy what I have in my notes here. It's going to be a little bit faster. The event could be reported on the financial statements as a footnote commenting the future performance of the company. For the second lawsuit, for the two widows, so the canceled contract didn't have any legal obligations to start with, so that's out of the question. DCI did make an offer to the two widows, right, of 150,000 each. But the widows are suing. The legal counsel think that there's a 10% probability of the widows being awarded the full amount, 20% probability of receiving a 2-year compensation, 20% of the company's offer. So in all cases, there's 100% chance, sorry, misspeaking, 100% chance of DCI paying money in regards to this lawsuit. So, so since we're following IFRS, we're going to calculate the weighted average of all these probabilities. So there's a 10% chance that the widows receive It's going to be 5 years times 250,000 times 2. So 2.5 million. So I did 5 years because the contract originally was 5 years times 250,000 because that was the fee for the year times 2 people. There is a 20% probability that they receive a 2-year compensation, so 2/5 of the 2.5 million. And there's a 70% probability that PCI is gonna just pay the offer that they originally proposed to the widows, which is 150,000 each, so 300,000. So here, the weighted average is these amounts, and the amount that they should report in their books is 660,000. So because it's under IFRS, you don't use the contingent liability account, doesn't exist. You're gonna put down like loss, accident, so recorded loss in your income statement for the year, and then on the liability for accident. The name of the accounts could differ, but it could also be an expense here. All right, so it's 660,000. So really important, don't put contingent liability here for IFRS, put liability for accident, put a provision amount, put anything but contingent liability, and put it in your balance sheet in your current or long-term liabilities, depending on what the problem tells you. For short-term debt refinancing. All right, so I'll move on. So for short-term debt refinancing, if we remember, under ASPE, what's the criteria is to put your short-term debt to accrue some of the refinancing into your long-term liabilities. First, your refinancing needs to be done with a long-term instrument. 2, your refinancing needs to be done before paying off the short-term debt. 3, the refinancing needs to be done prior to the financial statement release. Under IFRS, regardless of what's happening after year end, you put it all in current liabilities, unless at year end, what's the entity expects to refinance it or roll it over an existing agreement for at least 12 months. And it's up to the management to decide if they want to class it in their current or long-term liabilities. So for question 6, on December 31st, 2013, Hallow had 3 million of notes payable with Nations Bank maturing March 15, 2014. On March 1st, 2014, Halo Corp entered into a refinancing agreement with Gigantic Bank, allowing Halo to borrow up to 70% of its accounts receivable balance, which is expected to vary from 4 million to 5.5 million during the year. All amounts borrowed under the agreement bear interest at 2% above the bank's prime interest rate and mature 3 years from the date of loan. The agreement with Gigantic also requires Halo to maintain a working capital level of 8 million and prohibits the payments of dividends on common shares without prior approval by Gigantic. The company decided to borrow under the agreement with Gigantic and pay off the notes payable to nations on March 2nd, 2014. Thereafter, Halo released financial statement for 2013 on March 25th, 2014. Assume Halo reports under PGAAP, so ASPE. From the foregoing information only, the debt represented by the notes payable will be reported by Halo on its balance sheet dated December 31st, 2013 has, there's $0, 60,000 as current liability, 3 million as long-term liability, 2.8 million as long-term liability, or none of the above. So we're under ASPE now. So we're gonna look at our three little criteria here. So first, is the refinancing done with a long-term instrument? It is done with a long-term instrument. It's done with they borrowed, so it's done with the loan notes payable, long-term notes payable, and it's long-term because it matures in 3 years from the date of the loan. The amount of the long-term instrument here. So they say that 70% of their accounts receivable balance of the year, which varies between 4 million and 5.5 million. So what do? Do you do 70% of 4 million, 70% of 5.5 million, find the average of the two and put 70% of that amount? So because it's an amount that we don't know yet what it's going to be, the only value which you're sure that you're gonna have in your books, yeah, exactly, the lowest of the range. So the only amounts that you're for sure gonna have in your books is the lowest of the range, which is 4 million. Because that's like your lowest value. Like for sure in my accounts receivable, at the end of 2014, I'm gonna have 4 million. 5.5, it's the highest. We don't really know if that's gonna happen. Average, same thing. We don't really know if we're gonna have the average of the two. So we're gonna do the, so for the amount, it's gonna be the 70% of 4 million. Now, is the refinancing done before paying off the short-term debt? And I think, yes, I think the short-term debt was paid. It wasn't paid yet. Yeah, there's no payment date. So we're sure that they haven't paid their short-term debt. So that's a yes. And it needs to be done prior to the financial statement release. And that's also yes, because it was done on March 1st, 2014, and the financial statements were released on March 25th. That's yes. So that means that they can put an amount in their long-term liabilities. Now, what do you put? Do you put the 3 million or do you put the 2.8 that we calculated here? Any guess? All right, so the amount that you put in your long-term liabilities cannot be greater than your long-term instruments. So since our long-term instrument is 2.8 million, that's what we're gonna put down in our long-term liabilities. And then you're gonna have 200,000 in your current liabilities. So in this case, it's answer D. For IFRS, same question. So do they say that on December 31st, 2013, they expect to refinance it or roll it over an existing agreement for at least 12 months? I haven't seen that. So it's going to be the 3 million is going to be all in your current liabilities. And it's answer, I put the answer in the question. Whoops. Well, it's E. So you have the answer there. All right. So for question 7, we're done with chapter 13. Yay. So that means we're almost done with the review. All right, so for chapter, that's I think chapter 14, mixed with a little bit of chapter 16. So on January 1st, 2011, Wings and Things Inc. issued $1.2 million convertible bonds dated the same day. The bonds mature on January 1st, 2015, and interest is paid semi-annually on June 30th and December 31st. The fiscal year ends December 31st, and the company uses ASCII for reporting purposes. Furthermore, the company had decided to not record any portion of the bond issue to equity, and I would use the effective rate method to amortize any bond premium or discount. Neither the coupon rate nor the effective rate is being given to you. However, you are told that the bonds were issued for $1,161,000, and the amortized balance of the bonds payable as at July 1st, 2011 and January 1st, 2012 were was $1,165,000 and $1,169,000. And finally, you're also told that the cash payment made at each interest date, so the coupon amount was $54,000. Use this information to answer the following question and prepare journal entries where asked for. That they say that it could be useful for you to construct a partial amortization table, but that is not a requirement for this problem, but we're gonna do it because it's makes your life a lot easier. And then we're gonna have to determine the coupon rate, the effective rate, and we're gonna find the shredder at the end. So I'm gonna construct first my amortization table. So here I'm gonna put the dates, the cash, the interest expense, I think it's issued at a discount. Yeah, they're issued for less than their face value, so they're issued at a discount. And their balance. So on January 1st, 2011, they were issued for $1,161,220. Now there are convertible bonds, right? And the way I taught you last week is that when they're issued, you're gonna have your cash, you're gonna have your contributed surplus, conversion rights, and you're gonna have your bonds payable. In this case, in this problem, we have no contributed surplus recorded, and that's because they say that they don't record any portion of the bond issue to equity, and your equity is normally the contributed surplus. So that means that when they're gonna convert their bonds, you're not gonna put any amount in contributed surplus as a debit. So in this case, no contributed surplus amount. If they said that they recorded a portion of the bond issue to their debt or liability and equity, then that means that you would have the contributed surplus. So I'm closing the little brackets here. So on January 1st, 2011, that's your beginning book balance. Then they pay interest on June 30th. And the balance at June 30th is $1,165,281. And the book balance at December 31st, 2011 is $1,169,000. What we also know is that the cash amount is $54,000. They tell us here. So that's the information I have right now. So for one, the coupon rate. Normally, how do you find your coupon amount, your cash amount? You do your coupon rate times your face value, so your balance at the end. Now, to find my coupon rate, I'm gonna have to divide my coupon amount by my face value to get the percentage. And here, since we have 2 payment periods, I'm gonna do times 2 to get the rate for the year. So normally you do coupon rates times face value divided by the number of periods, and that gives me my cash amount. So here I'm going to do the cash amount. Oops. Divided by face value times the number of periods to get my coupon rate. So cash amount is 54,000. My face value is 1.2 million. And the number of period per year is 2. So their coupon rate is 9%. 2, you have to find the market rate. To find the market rate, normally we use it to calculate our interest expense, but no interest expense is given to us right now. So how do we go about it? We have the balances here, the book balances of 3 period. So we're going to find the difference between the two to find our discount amount. And then we're going to add the discount amount to our cash amount to find my interest expense amount. And then from there, I can calculate my rate. So I find first my discount amount for June 30th, 2011. So I'm doing the 1,165,000 minus my 1,161,000. That gives me a discount of $4,061. I add that $4,000 to my $54,000 to find my interest expense. Now with my interest expense, how we calculate it normally is we do our market rate times the previous book balance divided by the number of period to find that amount. So we're going to do a little bit, we're going to reverse that calculation to find my effective rate. So my effective rate is going to be my interest expense divided by my book value times the number of periods. So it's going to be 58,061 divided by 1,161 times 2. So it's 10%. Also here, why I added it to my cash, why I added the discount to my cash is because it's issued at a discount. If it was issued at a premium, you would have subtracted that amount from your cash. All right, so that's it for the first 2 requirements. Then we are doing the journal entry to record the interest payment on December 31st, 2012. So I'm just going to continue my table to add my June 30th, 2012, and to add my December 31st, 2012 to find my amounts. So here it's going to be 10%, the amount that we found here, times my previous book balance divided by 2. My discount amount is my interest expense minus my cash. And I add this amount to my previous book balance. And I'm going to do the same calculation here. To find my amounts for December 31st, 2012. So here I'm going to have an interest, oops. Going to have an interest, what's going on? Okay, interest expense of 58,701. I'm going to have cash of 54,000 and an increase in bonds payable of 4,701.
Sorry, how did you get the 1,174 million?
Here, this one?
Yeah, that one.
Yeah, so I added my discount amount to my previous book balance. And to find my discount amount, I did my interest expense minus my cash amount.
And where did that interest expense come from?
Yeah, the interest expense I did the previous book balance, so the 1,169,000 times the interest rate of 10% that we found in 2, divided by 2 because there's 2 payment periods during the year. You okay?
Weird. My number doesn't match.
Your number doesn't match.
Yeah, I have 58,273.
58,200. So do you have exactly the same number here?
Yeah, that's given, so that's already
Yeah.
there.
And here you did 10% of this.
10% times that divided by 2, right?
Yeah. You get the same amount.
I don't get it. Why do I have a different amount?
Yeah, I get the same thing on my phone. Yeah, I get the same number, and I have the same number also in my answer sheet. So maybe it's just like a dot that's wrongly placed. So maybe you did like, I don't know, maybe rounding here happened.
No, that's
You have the same thing.
okay. When I expand the 10%, it's actually 9.9765%. Okay. Okay.
Yeah.
Okay. Then for the 10%, how did you get the 10%?
Yeah, I divided my interest expense
Divide by that times 2.
balance January 1st times 2.
No, it gives me. Wait. This divided by that times 2. Okay, now I got it.
You got it? Okay.
Yeah, my 10% was wrong.
Okay, perfect. But just so you know, it's such like a small difference. It's gonna make you panic because your exam is multiple choice. But like normal, it would have been okay. So for requirement 4, how would the balance of the bonds payable as at December 31st, 2011 be reported? Show this in proper format. So you would have in your long-term liabilities a bond payable of 1,169,000. We're not recording any interest payable or anything like that because they're paid on December 31st, so you shouldn't have any payable for January 1st, 2012. Then part 5, assume that following the payment of the period's interest, the amortized balance of the bonds was 1,183,000 on June 30th, 2013. Use this information to answer the next question. The company converted 40% of the bonds by issuing 6,000 common shares. The shares of the company were being traded on that date at $85 each. Prepare the required journal entry in proper format to record this transaction. So what we want to come and do here is we want to reduce our bonds payable account by the 40% of our book value. And that's going to be the same amount that we were going to issue the common shares at. They're putting the market value here to trick you. Don't use the market rate. Don't do 6,000 times 85. It's not good. The reason why you're doing convertible bonds is to get a better rate than what's on the market. So you don't want to use it. So on June 30th, 2013, I'm going to come and reduce my bonds payable by 40% of 1,183,659. And I'm going to issue my common shares for the same amount. We have no contributed surplus. We don't do contributed surplus 40% of the amount at issuance because the wings and things only record, well, they don't record the equity portion of the convertible bonds. They only record the debt. the liability portion. So here I did 40% of 1,183,659. And is there any? No, the other ones you can find them there. All right. For question 8. About negotiating debt settlement. A loan which was to have come due on December 31st, 2017, and for which DCI wanted an extension of 6 years. The debt was in the form of a 5-year, 8% notes payable for $6 million, which had been issued at par plus the interest due on the note for 2017. DCI management had negotiated the new terms with the lender, the First Interspace Bank of Canada, Inc., as follows. The amended terms would become effective January 1st, 2018. DCI would transfer property with a book value of $260,000 in full settlement of the annual interest for 2017, which was due and unpaid as of December 31st, 2017. The principal payable was reduced to $5.5 million and will be due January 1st, 2021. And the annual interest coupon rate was to be reduced to 6% for the year 2018 to 2023. And the market rate was determined to be 12% on January 1st, 2018. The first required is show how this debt with the new terms is to be classified. Be sure to provide clear and sufficient computation to support your answer. So what they're asking us here is it a major settlement or a minor settlement? So is it seen as a new debt, or is it just the same debt with new terms? So what you want to do is you want to find the PV of the new debt using the old market rates. Compare that present value to the present value of the old debt. It's 10% higher. Then you remove from your books old debt and record the new debt. If it's 10% lower, you do a new amortization schedule, but you don't change anything on the date of issuance of the rates. So you would do like an amortization schedule with the PV of the old debt and the face value of the new debt, and you'll find an interest rate to compute. It's not really asked in the exam. It's more likely going to be 10% higher. Just so you know, it might have been asked in your assignment, but haven't seen it in an exam. So we're going to do that. So we're going to find first my PV of my old debt. And the present value is $6 million because it's due on December 31st, 2017. So we don't really have to crack our heads with that. And we're going to find the PV of the new debt. That new principal is $5.5 million. So that's the future value. The K, the market rate that we're going to use is the old market rate. So it's going to be 8%. Here. The number of periods is 6 years. I think here I think it should be 2023. Yeah, because I retyped them here. I think it should be 2023, but it's 6 years. The payment amount, you're going to use the new coupon rate of 6% times the new future value. So it's 330,000. And we can finally find the PV of the new debt, which is $4,991,000. And now what we want to do is we want to find, is it 10% higher? Is there a 10%, more than 10% difference between the two present values? So to do that, you do the PV of the new debt minus the PV of the old debt divided by PV of old debt. Should be, if I shouldn't put 10% higher, more than 10% difference.
Sorry, where did the premium come from? I didn't catch that.
It's the new coupon rate of 6%.
Coupon rate, 6%. Oh yeah, I found it.
Times the new face value of 5.5 million.
All right, thank you.
No problem. So to find the difference, we're doing 4.9 million minus 6 million divided by 6 million. And that gives us a difference of 17%. So that's more than 10%. So it's a major restructure slash, I don't remember the term. Or a major settlement, I think it said. But basically you, the 4.9 million, all this amount will be classified as long-term debt. And then for B, you're gonna do the book value. 1 for the transfer of the property and 2 for the recording of the negotiated debt. So for the transfer of property, what happened is that we transferred a property in exchange for their payment of their interest that was due on December 31st, 2017. So they transferred their, well, they don't have to pay interest anymore, so they can remove the interest payable. And the amount was 8% of 6 million. They're gonna have a gain or loss. And they're gonna give out a land. So they're gonna remove the land from their books, and the book value was 260,000. So since the interest payable amount was greater than the land that they gave out in exchange, they have a gain on disposal of land of the difference between the two, which is 120,000. For the journal entry for the negotiated debt, what you want to do is you want to remove from your books the old debt and put in your books the new debts, and any difference between the two is recorded as a gain or loss. So first I'm going to remove my notes payable old for the present value, which is 6 million. I want to record my new notes payable. And the amount here, because now we're recording it in our books, right? So it's not going to be the same present value as here, because here we use the old market rate. In our books, we want to use the new market rate. So I'm going to just copy this here. And the new market rate is 12%. So I'm going to put 12% here, and the rest shouldn't change. So that gives me, in my books, I'm going to record 4.1 million for my new debt. And the difference between the two is going to be a gain on settlement of debt. All right, for C, under renegotiated terms, would the first Interspace Bank of Canada make a gain or suffer a loss? Provide the journal entry which the bank would prepare to record this transaction in its books. So first, I'm gonna put first, they're gonna want to record the land that they acquired. So the land here They don't give us any mention. The bank records the land at the fair value in the market. They don't give us the fair value of the land, so I'm going to assume that its fair value is equal to the interest amount that DCI was supposed to pay. If they give you a fair value amount, then the difference between the fair value of the land and the interest amount that was supposed to be paid is going to be recorded as a gain or loss. And here I'm going to come and reduce my interest receivable because now it's the bank, so they were supposed to receive that amount for the 480,000. And then for the new debt, the bank doesn't really care for the new rate, so it's going to be, we're going to use the PV of the debt using the old market rate, find our amount, and we're also going to use the present value of the old debt. You could do like notes receivable 6 million, and then notes receivable 4.9 million, and then any difference between the two would go, no, that doesn't go as a loss, I think. Actually, I think what you do for the bank, you find the difference between the two, and you reduce your interest, your notes receivable account by that amount. So by this one, oh, what did I do? Okay. Why is it 10 million? Oh, I did some. Okay. Cool. Okay. So yeah. So you reduce your notes receivable account by the difference between the two. So now it's going to be at 4.9 million. And here it could be recorded as a bad debt expense. Could be recorded in your allowance for doubtful accounts. Could be recorded in your loss in your income statement. Depends on the choice that are provided on your exam. But all of these accounts are good. Just depends how the bank does their accounting. And the last question, question 9, for convertible bonds with warrants. So before I move on, if you want to take a, forgot to put it on here. So here you use the old rates. All right, so question 9. See, I had issued 7,200, remove a 0 here, should be 7,200 convertible bonds at 121 on January 1st, 2016. The $1,000 par value bonds carried an interest rate of 7% and a 10-year term. Along with each bond, 20 detachable warrants were also issued. Each warrant entitled the holder to purchase one share from DCI at a price of $54. Further, each bond was convertible at the option of the holder into 32 common shares. Interest was to be paid by the company on July 1st and January 1st. The underwriter estimated the market value of the bonds alone, excluding warrants and conversion rights, to be $7,470,000. Similar warrants were being traded at a market value of $4 each at the date of issue. We have been asked to view the situation on the assumption that the company uses ASP for its account and amortize the bond using straight line. Prepare the journal entry to record the issue of these bonds without crediting the full amount to liability. So we're using the residual equity method. So here we're gonna have contributed surplus conversion rights because they don't credit the full amount to liability. So at the issue date, so on January 1st, 2016, we're gonna have a cash amount of, the bonds were issued at 121. So it's gonna be 1.21 times the face value. They don't give us the fair value here, but we can calculate it because we have the number of convertible bonds times the value of those bonds. So it's going to be 7,200 times $1,000. So here I did 1.1 times 7 bonds times. Then you have your bonds payable. And they tell us that the value of the bonds payable without the warrants and conversion rights is 7,478,000. So that's what I'm going to record in my books. Then I'm going to have my contributed surplus warrants. And to find the amount, what you do is you find the number of bonds, you find the number of warrants per bonds, and you find the market value of the warrants on the issue dates. So here, the number of bond is 7,200. There is how many warrants? Oh, there is 20 warrants per bond. And their market, yeah, thank you. And the market value of the bonds on that date was $4. So that gives us a contributed surplus for the warrants of 576,000. And then we're going to record our contributed surplus conversion rights for the difference between my debits and my credits. So it's a plug amount. Even if you didn't have the warrants, it would just be a plug amount between your cash and your bonds payable. Then they ask us to prepare an appropriate journal entry to record the interest expense on December 31st, 2016. So that means that there has been 2 payments that have been done, right? The one on, no, there's only been one, and you want to accrue for the one on July 1st, 2017. The company used ASCII, and they use a straight line method to amortize their bonds. So that means that it's the same amount at each period. So to find the amount to amortize, you want to find the difference between the issue value of the bonds and its face value. So the issue was 7,470,000 that we put here, and the face value is 7,200 times $1,000, so 7.2 million. So that means that the over like 10 years, they're gonna have to amortize $270,000, which means that by periods, the amount of amortization is 270,000 divided by 10 years, divided by 2, because there's 2 periods per year. Then my coupon amount is 7% times my face value of 7.2 million divided by 2. Yeah, so they were issued at par, so my interest, well, technically, when you're using straight line, your interest expense amount is always a plug, so you can assume that your interest rate is also your coupon amount. So my transaction is going to be interest expense here. I don't know the amount yet, so I'm going to leave it blank. It's going to be an increase in my bond, a decrease in my bonds payable because my issue price is greater than my face value. So it was issued at a premium. So each period you want to come and reduce your carrying value of bonds payable to get to 7.2 million at the end of the 10 years. So I'm reducing my bonds payable by 13,500, and I'm paying cash 152,000. So my interest expense is this. So here for this, I did 7% times 7.2 million divided by 2. All right. For fee, on July 1st, 2018, 60% of the warrants outstanding were submitted to purchase shares. The market price of the shares was $62 each on that day. Prepare an appropriate journal entry to record this transaction. So, July 1st, 2018. What's happening here? The company is receiving the money from the warrants, and they're issuing common shares in exchange. So the amount of cash that they're receiving is so you want to find how many warrants were issued first, and then you're gonna time that amount of warrants by the purchase price on the warrants, which is $54. So to find the amounts of warrants that were issued, we know that 65% of the warrants that were issued. So I'm going to put down 65%. Yeah. The number of warrants, it's 20 warrants per bond. So I'm going to do 7,200 bonds times 20. So that should give me the number of warrants in total that were reclaimed. And then times the purchase price of $54 on the warrants. Then I'm also going to come and reduce my contributed surplus warrants by 65% because 65% was redeemed. And my common shares, do not use the price that is here. This is false. The common shares is just the sum of your two debits. Again, why is it not, I don't know how many shares it was, but why is it not that number of shares times the market price? Is because while they issued warrants, the warrants holders, the reason why they have it is because they're going to be able to purchase their shares at a lower price than the market rate. If we do the calculation, technically they bought the shares at $54 instead of $62, so it's better for them, right? That's why you're not using the market rate. And then for D, on January 1st, 2019. Oh, sorry.
So yeah, what's the contributed surplus warrant?
Yeah.
How did you get the number?
I did 65% of the amount that we had in our transaction of January 1st, 2016. So 65% of 576,000 to reduce this.
Oh, okay.
And here I did 65% and 7,000 bonds times 20 bonds times $54. And here, all right, so on January 1st, 2019, After the company recorded and paid off all interest due, 60% of the bondholders submitted their respective bonds for conversion. The company's shares were being traded at $68 on that day. Prepare the appropriate journal entry using the book value method to record the conversion transaction. So on January 1st, 2019, we have to find first our book value of the bonds payable because we're reducing our book value by 60%. We don't have to do an amortization table because technically they're using the straight line method. So we know each period how many, what's the value that they reduce their bonds payable by, right? So the book value at issuance was the $7,470,000. The amortization since then was 1,500 times the number of periods. So it's been 3 years, and there's 2 payments per year, so it's going to be times 6. And so my balance by 2019 is this minus this, 7,389,000. And only 60% was redeemed. So the dollar value of the redemption, well, converted. So the dollar value of that is 60% of our 7,389,000. My transaction is going to be a reduction of my bonds payable for that amount. It's going to be a reduction of my contributed surplus conversion price, and that's going to be 60% of the amount that we recorded at issuance. So 60% of 666. And then the common shares that were issued is just the sum of our 2 debits. So you don't look, again, you don't look at the market price that is given. So here it's just this I did. And 6 periods. This I did 60% times 666,000. And here it's applied. So how many shares would have been issued from the bond conversion on January 1st, 2019? They said that, what did they say here? For the convertible shares. Okay, so each bond was convertible at the option of the holder into 32 common shares. So what we have to do is we have to find the number of bonds that were converted and do that amount times 32 common shares. So there was 7,200 bonds times 60%, because only 60% of the bonds were converted, times 32 common shares. So that gives us 138,000 common shares were issued on January 1st, 2019 for the convertible bonds. So here I did 7,200 times 60% times 32 common shares. Don't come and divide this amount by the market price. It's not right. And that's it for the review. Do you guys have any questions? Want me to go back on an answer?